Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. Can't wait to get into this episode with you. You're listening to episode number 384. The title is 8 Tips for Dealing with Stock Market Volatility. And boy, oh boy, the last couple of weeks have been volatile. So we'll get the day started right two ways. The first one is with a verse. This comes to us from Galatians 5, verses 14 and 15. For the entire law is fulfilled in keeping this one command: love your neighbor as yourself. If you bite and devour each other, watch out, or you will be destroyed by each other. What's the best way to deal with stock market volatility? By investing in a good therapist. It has been a wild ride in the stock market lately. Volatility has been on the rise, and it seems like every day brings a new headline about the stock market crashing. So what's an investor to do? I'm going to give you a few tips and things to consider to help you survive stock market volatility and come out ahead in the long run. Remember, we have articles, links, and resources at soundretirementplanning.com. Just click on episode 384 for your continued education and reading enjoyment. The S&P 500 is officially in a bear market. Well, what is a bear market, you ask? A bear market is when the stock market falls 20% or more from its previous high. When we're talking about the market, we're usually talking about an index, and I find that most people refer to the S&P 500 as the market index when they refer to the term the market. The market, as measured by the S&P 500, hit its high on January 3rd, 2022, when it reached 4,796. Currently, the S&P 500 is down about 23% year to date. Now, it's easy to look at current volatility out of context of what has happened over the last several years. Remember, in 2019, the S&P 500 was positive 28.88%. In 2020, the S&P 500 was positive 16.26%. In 2021, the S&P 500 was positive 26.89%. Instead of expecting that the market is always going to go up in the short term, you have to remember that this is how the market works. Think of the market like the tides in the ocean. The tide comes in and it goes back out. Or think of it like breathing. We breathe in, we breathe out. The markets just don't go straight up. Volatility is normal. In fact, volatility is just noise. At least it is until you retire and then you have to live on your investments. Bear markets are not fun to experience, but it is the disciplined long-term investor who enjoys the returns that the market can provide. And then you say to me, yeah, but Jason, it's different this time. It's different this time. The sky is falling. The sky is falling. Sir John Templeton once said, the four most dangerous words in investing are, it's different this time. If we look back at the CRSP 1-10 index, which measures the performance of the total U.S. stock market, and we look at it from 1926 through 2021, the market was positive 72 years, or 75% of the time, and it was negative 24 years, or 25% of the time. The game that people try to play is to get out of the market and then get back in when they think it's safe. They want to be in the market for the 75 good years and out of the market for the 24 bad years. But here's the problem with that. If you look at the S&P 500 index from 1990 through 2021, and you just had a disciplined buy and hold, you would have enjoyed 10.76 annualized compound return. A $1,000 investment would be worth $26,322 over that time period. But if you missed the 5 best single days, you would have had a 9.18% annualized compounded return. Your $1,000 would be worth $16,625. If you missed the 15 single best days, you would have had a 7.15% annual compounded return, and your initial $1,000 would now be worth $9,113. Think about that. If you missed the 15 best up days because you were sitting on the sidelines waiting until you feel safe, you have $9,113 instead of $26,322. You see, there's a penalty for those who attempt to time the market. The penalty is you could end up with a lot less money. The challenge with timing the market is to be successful, you have to be right twice. When to get out and when to get back in. A lot of times, once people get out, they never get back in because they've believed the narrative that things are bad, getting worse, and how could we ever recover? Remember, the stock market is a leading indicator, meaning it typically starts to go up before the economy improves. It's hard for people to believe that things can get better when they feel like they're in the middle of a really bad situation. Imagine if we were to go back to 1997. You remember that time? We were just on the cusp of Y2K and the tech bubble was just about to burst. I had friends who were buying rain barrels and shotguns. They were convinced that computers would crash, the grid would fail. We'd go back to living off the land, raising chickens and trading gold with one another. I remember waking up on January 1st and turning on my computer with anticipation. Would it work? Well, here we are. Think about some of the events that occurred from 1997 through 2021. We had the tech bubble burst. We had the financial crisis. We had the September 11th terrorist attacks. We had a global pandemic. If I had told you back in 1997 we were going to live through all of that turmoil, all of those scary things, would you have been an investor? From 1997 to December of 2021, the U.S. stock market returned on average 9.8% per year. The reason that long-term investors make money in the stock market is that they're being compensated for the risk they're taking. There is uncertainty, and it is the risk that makes investing valuable. If there were no risks, you would not expect healthy returns. It's important to remember that humans, we are hardwired to focus on the negative. The YouTube thumbnail that has a guy with both hands on his head and the bright yellow lettering that says, "The collapse has begun," is the image that we all want to click on. When I was driving home last night, there was a pretty extreme accident. The traffic was bad because people want to slow down to see what happened. Remember, negative is normal. It's not healthy, but it's normal. This is why Warren Buffett says that the greatest attribute for a successful investor is not IQ, but rather temperament. You have to have discipline to stay the course when everyone else is freaking out. Even better than staying the course is to be able to buy when everyone else is selling. Another way to do this systematically without sitting on a huge pile of cash is to rebalance. When I was rebalancing the other day, I was selling short-term bonds and value stocks, both of which have held up better than growth stocks this year. But then I was buying growth stocks. Now that doesn't feel good amid the turmoil. Most people want more safety when things look bad. But this is what temperament is all about. This is what discipline is all about. This is what having a plan and investment strategy is all about. Everyone acts like they're so cool and calm and collected until the storm hits, and then all of a sudden they flip the switch and they go into panic mode. Look, you don't need to panic. Remember, the markets breathe in and out, up and down. This is not the end of our economy. We're not going to be trading one another chickens for gold. This too shall pass, and history shows us that those who have the proper temperament will likely be rewarded accordingly. Here are a few quotes to consider. Jim Rohn, this is one of my favorites. He says, "All men will experience pain, the pain of discipline or the pain of regret. Discipline weighs an ounce, regret weighs a ton." David Campbell says, "Discipline is remembering what you want." Charlie Munger, he says, "You need patience, discipline, and an ability to take losses and adversity without going crazy." Abraham Lincoln says, "Discipline is choosing between what you want now and what you want most." And Benjamin Graham says, "But investing isn't about beating the others at their game. It's about controlling yourself at your own game." We need to know where you're at in your investing life so that we can determine the best course of action for you. I can't give you specific investment advice because I don't know your situation. But if you're young and working and investing, then I'll tell you that I'm not personally getting more conservative right now with my own investments. Now is the time for me to invest more, buy more, be more aggressive. Every month, I buy more stocks, a very aggressive asset allocation using low-cost ETFs. And I can't wait to buy more. If you're in your 40s and 50s and have more than 10 years before you retire, this correction, this bear market, is a buying opportunity that many of us have been waiting for. Now, if you're about to retire or recently retired, it sure feels good to have a bucket strategy in place where you know your spending is coming from low-risk assets in the early years. The buckets buy you time for recovery. The buckets buy you the ability to sleep at night. The buckets buy freedom from worry. Oh, sure. The academic data shows that you may end up with lower returns by using buckets, But that's assuming that you can stay the course in a non-bucket strategy in times of uncertainty. Buckets help create a mental framework, remembering that some of your money is needed in the short term. Short-term money needs to be defensive. Buckets also help you to know how much of your money is not needed right now so that it can be thought of as long-term money. Long-term money can be more aggressive because we have time on our side to recover from short-term volatility. If you've been listening to Sound Retirement Radio, or you've read my book, or you've purchased the Retirement Budget Calculator, then you know that this is what I've been teaching people for more than 10 years. If you use the Retirement Budget Calculator, it helps you visualize what a bucket strategy would look like for your specific situation. Everyone is always so confident when the market's going up. I know what the academic community says, and I know what it means to have boots on the ground and to walk life with people heading into retirement. And for those who are retired, I know what it takes to create a plan that helps people stay the course. So how long, you ask, does the bear market typically last? It's usually about 2 years for the stock market to recover from a bear market. Here are 8 tips to help you survive stock market volatility. Number 1, stay disciplined and don't try to time the market. Given enough time, the stock market has always gone up. So if you can ride out the ups and downs, you will be rewarded in the long run. Number 2, focus on your goals and don't let short-term fluctuations derail your long-term plans. Number 3, stay diversified and remember that stocks are just part of a well-rounded investment strategy. Time is the cure to the volatility of the stock market. The money you need in the short term for income is more conservative, and the money you don't need for 10 years can be more aggressive. Number 4, keep things in perspective and remember that stock market corrections are a normal part of investing. They provide an opportunity to buy stocks at a discount. This is especially important for those of you still young and contributing and making money and making a difference in the world through your career. Number 5, don't let your emotions dictate your investment decisions. Stick with your plan and discipline yourself to buy when everyone else is selling and to sell when everyone else is buying. It's called buy low and sell high. Another name for it is rebalancing. Number 6, stay informed, but don't get overwhelmed by the news. It's important to stay up to date on what's going on in the market, but don't let the news dictate your investment decisions. Number 7, have a plan and stick to the plan. Discipline is the key when it comes to investing. Having a plan will help you stay disciplined, focused on your goals. Number 8, seek professional help if you need it. If you're not comfortable managing your own investments, seek out a professional who can help you put together a well-diversified portfolio that meets your needs and matches up with your plan. If you've recently changed your strategy, sold, and gone to cash, then you're probably in need of some help. And here's a bonus one for you. Working longer, sequences of return, or tax planning are all less significant than creating a solid financial plan. It's seldom about have you saved enough, and it's usually more about how much do you spend. So in summary, it can be difficult to stay calm during a stock market correction or bear market, but it's important to remember that these fluctuations are normal. If you have a well-diversified portfolio and a disciplined investment strategy, you will be well-positioned to weather the storm and come out ahead in the long run. Seek professional help if you need it. And stay informed, but don't get overwhelmed by the news. Most importantly, stick to your plan. Discipline is key when it comes to investing. Having a plan will help you stay disciplined and focused on your goals. If you're within 5 years of retirement or you're recently retired, use the Retirement Budget Calculator to help you visualize what a bucket strategy would look like for your specific situation. I'll have a link to the Retirement Budget Calculator in the show notes.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent, fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.